Imagine spending 40 years paying off your house, finally deciding to downsize or move closer to your grandkids, and then discovering that one single decision could quietly slash your age pension by thousands of dollars a year. It sounds unfair, almost like a trap, but it happens to ordinary Australians every single week, and almost nobody warns them about it before they sign the contract. If you or someone you love is thinking about selling the family home after retirement, what you're about to hear could save you a fortune or cost you one if you ignore it. Welcome back to Aussie Benefit, the channel where we break down the confusing rules around pensions, Centrelink, and retirement so you can make smarter decisions with your money. If this is your first time here, hit that subscribe button and tap the bell because we cover these hidden traps every single week. And trust me, this one about selling your home is a rule that catches out even financially savvy retirees. Today we're diving into exactly how selling your principal home can affect your age pension, why the rules are more complicated than they look, and what you can actually do to protect your payments. Let's get into it. Here's the first thing you need to understand. Your home, the one you actually live in, is completely exempt from the age pension assets test, no matter how much it's worth. Whether your house is worth $400,000 or $4 million, Centrelink does not count it against you while you're living in it. This is why so many retirees assume selling is completely safe too. But the moment you sell that home, everything changes because the cash sitting in your bank account from that sale is no longer protected. It becomes what's called an assessable asset, and it gets counted immediately from the date of settlement. This is where the real trouble begins. As soon as those sale proceeds land in your account, they get added to your total assessable assets. And if that pushes you over the threshold, your pension gets reduced, or in some cases, cut off completely. Under current rules, a single homeowner can hold assets up to a certain threshold and still receive the full pension, while couples who own their home have a combined threshold. Once you cross that lower limit, your payment starts tapering down, and if you go above the upper cutoff point, you receive nothing at all. Selling your home can easily push retirees who were previously receiving a full pension into only a part pension, or worse. Now here's the part almost nobody tells you about, and it's actually good news if you plan it correctly. If you're selling your home with the intention of buying, building, or even repairing another principal home, Centrelink allows what's called an assets test exemption on those proceeds. For homes sold from January 2023 onwards, this exemption lasts up to 24 months from settlement, and in certain circumstances you may even be able to extend that by a further 12 months. Giving you up to 36 months in total. During this exempt period, the portion of your sale proceeds earmarked for your next home isn't counted against the assets test the same way other savings would be. However, and this is critical, that exemption doesn't mean the money disappears from the equation entirely. While the funds are protected from the assets test during that window, they're still subject to something called deeming under the income test. Deeming rates assume your money is earning a certain rate of return whether it actually is or not. But the good news is that money held for the purpose of buying your next home is deemed at the lower rate only, rather than the higher rate that applies to larger balances. This distinction matters because your final pension payment is always based on whichever test, the assets test or the income test, gives you the lower result. So understanding both sides is essential before you make any big moves. Another detail that trips people up is what happens to any leftover money that isn't going toward the new home. Let's say you sell your house, put a portion aside to buy your next place, but you also walk away with extra cash you plan to invest or keep in savings. That surplus amount is treated as a regular financial asset from day one. It doesn't get the same protection, it gets deemed at the regular rates immediately, and it counts fully under the assets test straight away. This is exactly why so many retirees are shocked when their pension drops even though they thought they were being careful. There's also a timing trap that catches people off guard. The 24-month exemption clock starts ticking from the date of settlement, not from when you actually move out or decide to buy your next home. If the property market is slow in the area you're looking to buy, or if you're taking your time finding the right place, that clock keeps running regardless. If you haven't secured a new home by the end of that exemption period, you may need to apply for that additional extension, and if you still haven't purchased anything, those proceeds become fully accessible going forward, which can significantly reduce your pension without any warning letter arriving in your mailbox first. So what should you actually do if you're thinking about selling your home in retirement? The smartest approach is to plan the entire transaction before you even list the property, not after you've already got the cash sitting in your account. Talk to a financial advisor or a Centrelink financial information service officer. Get a clear picture of exactly how much of your proceeds will be protected, how long that protection lasts, and what your realistic timeline looks like for buying your next home. Understanding these numbers in advance can be the difference between keeping your full pension and watching it shrink month after month. The bottom line is this: selling your home doesn't automatically destroy your pension, but it absolutely can if you don't understand the rules around exemptions, deeming, and timing. Too many Australians find out the hard way, months after settlement, when their payment has already dropped and there's little they can do to reverse it. Knowledge really is power here, and now you know exactly what to watch out for. If this video helped clear things up for you, do us a favor and hit that like button. It genuinely helps this channel reach more Australians who need this information before they make a costly mistake. And if you haven't already, subscribe to Aussie Benefit so you don't miss our upcoming videos where we break down superannuation traps, Centrelink loopholes, and practical strategies to protect your retirement income. Drop a comment below if you've got questions about your own situation. We read every single one. Thanks for watching, and we'll see you in the next video.